Good evening from New York. It's 5:51 p.m. on Friday, March 27th, 2026. Welcome to the Lynx Data Insight market briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is now closed after hours, and what a brutal close to the week this was. Let's get straight into it.
Brutal is the right word, and the data leaves no room for ambiguity. The S&P 500 closed at 6,367.77, down 1.69%. The Nasdaq fell 2.15% to 20,947. The Dow dropped 1.74% to 45,158. The Russell 2000 lost 1.73%. This was broad-based. The advanced decline line came in at 135 advancing versus 375 declining. The VIX closed at 31.06, which is firmly in the elevated fear zone, and the 10-year Treasury yield sits at 4.44%, with the 2-year at 3.61%, so we have an 83 basis point positive spread on the curve. This is a classic risk-off regime, driven by a dual catalyst: the energy supply crisis in the Strait of Hormuz, pushing oil to its highest level since 2022, and a secondary layer of tech-specific pressure from Meta's legal woes, the Anthropic cybersecurity scare, and Google's TurboQuant algorithm hitting memory chip stocks. According to CNBC, the Nasdaq just posted its worst weekly drop since April 2025.
Let's dig into the primary catalyst. Oil touched $100 intraday. Walk us through what's happening in the Strait and why the market isn't buying the diplomatic narrative.
WTI crude closed at $99.64, up 5.46% on the day. Brent settled at $112.57, up 4.22%. WTI actually hit a session high of $100.04 before pulling back slightly. These are the highest closes since July 2022, when the Russia-Ukraine war was roiling energy markets. Now, President Trump gave Iran a 10-day extension through April 6th, pausing attacks on Iran's energy infrastructure and claiming negotiations are going well. But the market saw through that almost immediately. According to marine traffic, 2 container vessels from China's COSCO, the world's 4th largest shipping line, attempted to transit the strait and were turned back. This was the first attempt by a major carrier since the war started. The message from that is unambiguous. The strait remains functionally closed to normal commercial traffic. Rystad Energy's chief oil analyst, Paola Rodriguez-Maciu, put it perfectly. The global system has shifted from buffered to fragile. Rystad estimates nearly 17.8 million barrels per day of oil and fuel flows have been disrupted, with close to 500 million barrels of total liquids lost so far. The pre-war inventory cushion is depleted.
That number is striking. 500 million barrels of total liquids lost. And what about the secondary pressure on tech? Because the Nasdaq took the worst of this.
Right, and this is where the multi-factor nature of today's sell-off matters. Oil is the macro headliner, but tech had 3 distinct sources of pain layered on top. First, Meta platforms dropped 2.57% today and over 11% for the week after 2 damaging court verdicts, nearly $400 million in damages from the New Mexico case alone, and a separate negligence finding in Los Angeles. There's now serious talk, according to New Mexico Attorney General Torres, that Congress may re-examine Section 230. That's a structural overhang, not a one-week story. Second, Anthropic's new Mythos AI model, reported by Fortune, rattled the entire cybersecurity complex. The iShares Cybersecurity ETF fell 4.5%. CrowdStrike, Palo Alto Networks, Zscaler all dropped about 6%. Tenable plummeting 9%. The fear here is that more powerful AI models increase the sophistication of attacks, potentially commoditizing security capabilities. Third, and this flew under the radar but hit semiconductor stocks hard, Google announced a new TurboQuant algorithm that reportedly reduces memory requirements for AI models significantly. That slammed Micron, which was already down over 15% for the week, despite posting blowout earnings, with revenue nearly tripling to $23.86 billion. Lam Research, Applied Materials, AMD all fell sharply in the afternoon session as investors repriced memory demand assumptions.
So you have oil spiking, tech getting hit from multiple angles, and the VIX above 31. Let's connect the cross-asset picture here. What are bonds, gold, and currencies telling us?
This is where the causal chain gets really instructive. Oil moving toward $100 feeds directly into inflation expectations. That pushes the 10-year yield to 4.44%, which is meaningful. It tightens financial conditions across the economy. Higher yields raise mortgage rates, compress equity multiples, especially for long-duration growth stocks, and strengthen the dollar. Now, the energy sector is the only major sector where 100% of stocks are trading above both their 50-day and 200-day moving averages, and 91% are near their 52-week highs. Meanwhile, only about 21% of tech stocks are above their 50-day moving average, and 27% are near 52-week lows. That divergence is the visual signature of a supply shock rotation. Gold miners like Newmont rose 3.31% today. That tells you the safe haven bid is alive. Utilities also held up, with Entergy gaining 3.61%. Consumer defensive names like Campbell's were up 4.61%. So the cross-asset signal is consistent. Capital is rotating out of growth and into real assets, defensives, and inflation beneficiaries. The correlation between oil and the Nasdaq is deeply negative right now, and that's entirely consistent with an energy-driven inflation shock, repricing risk assets.
That's a clean rotation story. So let me ask the question every investor is asking. What does this mean for the Fed?
This is the critical nuance. The Fed's reaction function distinguishes between energy-driven headline inflation and core inflation. Historically, the Fed looks through energy shocks unless they persist for multiple quarters and begin to feed into core prices and inflation expectations. We're about 4 weeks into this Strait of Hormuz disruption. Gasoline is at a national average of $3.97 a gallon, up roughly 33% from a month ago, according to AAA. That's a significant hit to consumer purchasing power, but it's not yet core inflation. Treasury Secretary Bessent said Thursday he believes energy prices will be lower once the conflict ends and called this short-term volatility. The administration insists the war will last about 6 weeks. Here's the problem. The market can't price a 6-week assumption when COSCO ships are being turned away and Rystad says the buffer is gone. What was a rate cut narrative 3 months ago is now firmly on hold. The 2-year yield at 3.61% suggests the market still sees the Fed funds rate roughly where it is, not materially higher. But if oil sustains above $100 for another 4 to 6 weeks, we could see break-even inflation expectations begin to unanchor, and that's when the Fed would be forced to, at minimum, signal hawkish intent, even if they don't hike. The Kevin Warsh confirmation process adds another layer of uncertainty. Senator Tillis is blocking the nomination, and Powell has said he'll stay as chair pro tem if Warsh isn't confirmed by May. So the Fed leadership itself is in flux during what could become a pivotal inflation moment.
So who are the clear winners and losers from today?
Let me break this down in layers. Cyclical winners. Energy producers, without question. ExxonMobil rose 3.22%. Halliburton gained 3.69%. 100% of energy stocks are above both moving averages. They're the direct beneficiaries of crude approaching $100. Gold miners are a second cyclical winner. Newmont up 3.31% as the safe haven and inflation hedge bid strengthens. Consumer defensive names like Campbell's, up 4.61%, are winning as investors hide in low-beta pricing power stocks. Structural winners, utilities with data center exposure. Entergy gained 3.61% and sits in the sweet spot of regulated returns plus secular demand from AI power consumption. Brown-Forman surged 4.61% on reported merger talks with Pernod Ricard, which is a consolidation story in spirits that plays out regardless of the macro backdrop. Cyclical losers, consumer cyclical names tied to discretionary spending. Norwegian Cruise Line fell 4.98%. Airbnb dropped 4.95%. Higher oil prices mean higher travel costs, higher input costs, and weaker consumer confidence. Cybersecurity stocks are a cyclical loser this week. The entire sector repriced on the Anthropic Mythos news. Structural losers, Meta Platforms, down nearly 19% over the past month, faces compounding headwinds from legal liability, regulatory risk around Section 230, and rising AI competition. That's not a one-quarter problem. Memory-exposed semiconductor names like Micron face a structural question mark after Google's TurboQuant announcement. If AI models can run on significantly less memory, Micron's demand thesis needs to be recalibrated, even though near-term supply remains tight. Real estate is also a structural loser. Nearly 48% of real estate stocks are near 52-week lows, with the 10-year at 4.44%, compressing cap rates and raising financing costs.
Now, Meta is interesting because it's down nearly 19% over the past month, but those court verdicts represent a potentially new category of legal risk. Is that priced in?
Not fully, and here's why. The $400 million New Mexico verdict and the Los Angeles negligence finding are the first major signals that Section 230 protection may be eroding for platforms that deploy AI to serve content. Attorney General Torres explicitly said there's a distinct possibility Congress re-examines Section 230. If that happens, Meta and Google both face a fundamental repricing of their liability profile. Meta is already trading at $525, more than 23% below its 50-day moving average of $643. The stock is essentially in a bear market within a broader bull market. And the Epstein victim lawsuit against Google filed this week tests whether AI-generated search results can pierce Section 230 protections. These are structural, not cyclical risks.
What's the risk case investors should stress test heading into the weekend?
Base case, which I'd assign the highest probability, the Trump-Iran 10-day negotiation window produces some limited de-escalation. A handful of tankers resume transit. Oil drifts to the $90 to $95 range over the next 2 weeks. The 10-year yield stabilizes around 4.3 to 4.5%. The S&P 500 finds support around 6,200, roughly a 3% pullback from here, before stabilizing. The Fed stays on hold through mid-year, and the VIX gradually reverts toward 25. That's the muddle-through scenario. Risk case, lower probability but materially higher impact, negotiations collapse by April 6th. Iran fully closes the Strait of Hormuz to all traffic. Oil spikes to $125 to $135 per barrel. That forces the 10-year yield toward 4.75 to 5% as inflation expectations unanchor. The S&P 500 could see a 10 to 12% correction from current levels, taking it toward the 5,600 range. Consumer discretionary names could fall another 15 to 20%. At that point, the Fed faces a genuine stagflation dilemma. Tightening into a supply shock would crush growth, but doing nothing risks losing credibility on inflation. The VIX in that scenario would likely breach 40.
Let's talk positioning. How should investors think about their portfolios heading into next week?
Highest conviction, energy producers. Immediately increase exposure if underweight. ExxonMobil, Halliburton, Devon Energy, these names have momentum, fundamentals, and the macro tailwind. They're the clearest beneficiaries of a supply-constrained environment. Secondary conviction, consumer defensive names and utilities with pricing power. Maintain or gradually increase over the next quarter. Campbell's, Procter & Gamble, Entergy, these are your ballast in a portfolio when the VIX is above 30. Tactical hedge, gold and gold miners. Newmont is already working, and if the risk case materializes, gold becomes the ultimate cross-asset safe haven. Avoid Rate-sensitive consumer discretionary, cruise lines, travel platforms like Airbnb, and luxury goods names. Also, avoid adding to cybersecurity names until the AI disruption thesis stabilizes. Reduce overweight positions in mega-cap tech, particularly Meta and memory-exposed semiconductors. The legal and technological headwinds are multi-quarter in nature. Time horizon matters here. Tesla reports quarterly deliveries next week, and SpaceX is lining up April investor briefings ahead of what Bloomberg describes as potentially the largest IPO on record. Those are potential catalysts, but in this macro environment, the risk-reward for adding ahead of those events is unfavorable.
How does it all fit together?
When you step back, this is really about the collision between a geopolitical supply shock and an already fragile tech leadership structure. Oil approaching $100 is repricing inflation expectations, pushing yields higher, compressing growth multiples, and forcing a rotation from the sectors that led the market for the past 2 years into the sectors that had been left behind. The 500 million barrels of liquids lost from the Strait disruption, the VIX above 31, Meta's legal reckoning, and Google's turbo-quant disrupting the memory thesis, these are all manifestations of a market that's transitioning from a growth-led regime to a supply-constrained, defensively oriented environment. Now, the alternative reading, and it's important to state it, is that this remains a temporary supply shock. If the 10-day negotiation window produces a credible agreement and oil retraces below $90, yields could fall back rapidly and the tech sell-off would likely reverse. The energy-to-tech rotation would unwind, and this entire week would look like a buying opportunity in hindsight. The data doesn't tell us which scenario will prevail. What it tells us is that the balance of risks has shifted meaningfully, and positioning should reflect that.
Give us 3 takeaways to carry into the weekend.
1. The risk. The Strait of Hormuz is functionally closed to normal commercial traffic despite diplomatic efforts, and Rystad says the global oil buffer is depleted. That's the single most important variable for every asset class right now. 2. The market insight. The rotation from growth into energy, defensives, and gold is not noise. It's confirmed by sector breadth data showing 100% of energy stocks above key moving averages, while only 21% of tech stocks are. That's a regime signal, not a blip. 3. The positioning idea. If you're still running a tech-heavy, growth-tilted portfolio, this weekend is the time to stress test your exposure against the risk case of sustained oil above $100. The market is telling you to rebalance toward real assets and pricing power before it forces you.